Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Hello again, Don here. Thanks for listening to the podcast. Just finished doing the show, which on Monday will become the Monday podcast and the Tuesday podcast. And I'm here for another exciting episode of Quick Query, Rapid Response. Or no, it's Rapid Reply. It's one of those. Response, reply, who cares? Where I take one of your questions and answer it very quickly on a Saturday so that there's a podcast for you to listen to on Saturday so you don't have to go through as much withdrawal. Now, there'll be a podcast on Monday, but that's a while away. So here is today's Quick Query, Rapid Reply question.
Hey, Don and Tom, this is Bob in Gig Harbor. Love your show. I've always appreciated your investing across the broad market for diversification. Warren Buffett says the best thing to do would be to get into some kind of an index fund. Here's my question. I'm retired about a year, and my investments are all in a couple of just a small, I shouldn't say small, but a couple of index funds. For example, Fidelity has a very diversified fund, FSKAX. And my question is, you invest in something like that. What is the difference between that and investing in one stock like Berkshire Hathaway, which by its very content is well diversified across a broad spectrum of stocks? Now, I know Berkshire Hathaway does not pay a dividend, and Fidelity does across their index fund. But I'm just curious what one position versus the other, what the differences or advantages or disadvantages would be from that aspect. Thanks. I appreciate all you guys do. Bye-bye.
This is an apples and oranges kind of choice. The FSKAX, the Fidelity Total Stock Index Fund, is a fine fund, by the way. Really well diversified, incredibly low cost. However, it doesn't have a lot of history, so it's tough to do a comparison. And I love to do comparisons because it gives you a better idea what you're getting and why you're doing what you're doing. Remember, investing is a constant series of trade-offs between taking risk and expected returns. Berkshire Hathaway has done exceptionally well over the longest of long hauls. However, most of those big gains happened long ago and far away when Warren Buffett and Charlie Munger were much younger men. Because a huge part of what made Berkshire Hathaway special was the fact that their people actively managed, not just actively managed the portfolio, picking which stocks to own and which stocks to sell, but they actively managed the businesses in which they invested to make them better, to make them grow more. So Berkshire Hathaway is less like a mutual fund and more like a giant conglomerate that just happened in the past to have run its subsidiaries very, very well. Remember, there are only, there are less than 40 stocks last I looked in the Berkshire Hathaway publicly traded stock portfolio. So it's small, which makes it more risky. And its more recent returns, and by recent, I still mean pretty long term, its 15-year return has been about 11%, just under 11%. While we can find a fund that has a similar history and is as well diversified as the Fidelity Total Stock Index, and that's the Vanguard Total Stock Index, actually the investor shares, which are older, VTSMX, their 10-year average annual return was 10.33%. So pretty close over 15 years. But because you own 3,700 stocks in the total market portfolio, just like you do in the Fidelity, you have much, much, much better diversification, and therefore you should have reduced volatility, and that's been the case, so greater safety. There's more safety in numbers. And over 10 years, the total market has beaten the Berkshire Hathaway portfolio by about 1.33% per year. So you would have been better off money-making wise, too. Now, that's not indicative of what the future might bring. But what it says is, with a broadly diversified portfolio, you can expect to do about as well, maybe a little less well, but it's a trade-off because you've got greater diversification, therefore a portfolio that's more comfortable to hang on to long-term. And the other thing about Berkshire Hathaway, given that it is not a mutual fund, is what's going to happen when there is no Warren Buffett or Charlie Munger? Things could change. I wouldn't want to bet on that. So I would stick with the diversified index fund. I know it's not sexy. It's not meant to be sexy. It's meant to be sane. And that's good. Don't try to beat the market. Be happy to be the market, because people who have been the market have actually done well than most people who've tried to beat the market. Play the odds. They're in your favor. Thanks for the call and the question. I appreciate it. 855-935-TALK. That is our phone number. You can call that 24 hours a day with your questions, or you can send your questions in, either vocally or typewritten, at talkingrealmoney.com on the contact form. And since we still have a few days left, on the 29th of April, if you're listening to this before the 29th of April, Tom and I are doing a quick lunch class at noon Pacific time, 3 p.m. Eastern, called Real Investing, Less Taxing. So it's about the process of really investing, the right way to invest for your future, how to plan for your future, and how to at least reduce the taxation. There's no magic trick, but we can help you reduce it somewhat. So sign up for that class right now at talkingrealmoney.com, talkingrealmoney.com. Thanks for listening. Please tell your friends, your relatives, your neighbors, anybody you bump into. And if you really like what you hear, please leave a review at Apple Podcasts. And as always, I'm just going to hang out here talking real money. I'm Don McDonald.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.